So
Well, we all know too, Adam, how many times you've heard the client say, well, I saw someone on TV and they said the market's going to go down another 20%.
yeah.
I kind of take these
That
guys.
person never comes back on when it doesn't go down 20%. They just
They
predict
also don't
again
have
it's
any
going to go
money.
down. Yeah, and what do we always say, right? If you keep predicting that the market's going to go down, eventually you're going to be right. It's the old broken clock. Like it's right twice a day. Eventually you're going to be right, but it doesn't mean that over time that's going to be the way to make money. Thought we'd just kick it off real quick with where we're at here in 2022, and then talk a little bit about the questions we're getting from clients and things that are going on in the market. Two things basically driving the market. We drowned out the noise. The first thing is obviously inflation. Apparently it wasn't as transitory as we had hoped or has been told to us. Go back to econ class. Very definition of inflation is too much money chasing too few goods and services. So you stop supply chains. You inject money into the system. Not making a political call on whether that was the right decision or the wrong decision. Maybe the alternative was worse, but we'll never know. But we did add money to the system, and we stopped all of our production mechanisms and like I said, supply chain economics. So now here inflation is a couple of months later. And into 22, it's as high as it's been in 40 years. So on that note, stocks react negatively to inflation. We have the Federal Reserve. Their main job outside of not crippling the economy is to keep inflation under control. So the Federal Reserve's had to step in and act. Some say a little bit too late, but they've started to raise rates, and the market understands that more rate hikes are coming. So you have the combination of inflation as well as interest rates raising, and that's driving where we're at here in mid-May 22.
Well, and specifically bonds. I mean, we've been talking for years about when interest rates go up, it's going to hurt bonds, right? And I have a chart here where we can look at it, but it's the worst start that we've seen in bonds really ever, according to BlackRock, ever. So it's been really rough, and the hard part about that, of course, for us as advisors is this is supposed to be safe money, right? We always frame it that way, and unfortunately, this year, stocks and bonds have price-wise have both gone the same direction. So I mean, like the theme with a lot of this stuff is going to be pretty simple. It's going to be it's rough right now, but it's probably, somewhere down the road, it'll get a lot better. And because that's been history. It's been recorded history. It always gets better. It's just not on our time. And because I think if everybody here would say we'd get to the better part right away. But yeah, with bonds being down so much, and equities being down so much too. I mean, it's been rough. And if you turn on really any bit of business news, I think we're going to dig into inflation and a few other things a little bit later, but it's been a really bad year for stocks too. I mean, another chart up here that this shows is through the end of April, third worst start for stocks, and so both of those combination, or that combination of the two, means that most of our client portfolios are down a lot more than I think we would have expected if we had this call, say, 6 months ago. So, but again, I mean, you guys know this, of course, but there's been a lot of the smaller names that have been beat up, going back into last year. And what we're seeing now, I think, is we're seeing the bigger names, the Apples, the Amazons, the Googles, the Ciscos today. You're seeing those guys sort of come through and get hit also. And nobody's going to be completely immune, but it's one of those things where, like in a lot of cases, you end up getting through the pain pretty quickly. Adam, what do you always say? It goes down quickly and it recovers slowly. So
yeah,
up the stairs, down the elevator.
Yeah,
a lot of that too, right. Chris, is kind of what you were saying before, and we were talking about in the office the other day is, the hardest part about this market lately for us and conversations we're having with our clients has been the interest rate impact on bonds. And a lot of that usually is our safe money. And so it's harder conversations with clients that are sitting at maybe, 60% equity, 40% equity, and they're their portfolios are doing similar to the client that may have 20% equity and 80% fixed income. And, the slides you showed there that, highlighted the worst year we've ever had in bonds highlights that, they're down 9-10%. We've talked about clients with municipal bonds being down potentially, 12 or 14% in just
Mm-hmm.
muni markets. And so when we're having conversations and talk around with clients and the portfolios and the balanced approach, Jason, you were showing us a slide the other day when we were talking and having a conversation about, your average 60-40 portfolio is still down, similar to the ones that are high equity exposure. And that's what's made this market more difficult, I think, in conversations, a little bit more difficult the last 3 or 4 months.
Mm-hmm.
It's been difficult for a lot of folks, and anyone who's scared, you're not having feelings that are unique. And so everyone feels this, that we're all in the same boat. The only people making money right now might have been the people betting for Armageddon, pouring all their money into certain commodities or things like that. But, we'll show you later that buying all the flood insurance in Vegas, it doesn't rarely pay off. And so most of us, 99% of us are in the same boat. I've got a slide up now that'll show the most common portfolio would be something like a 60-40, 60% stock, 40% fixed income. And that's how most people invested for a very long time. And so what you're looking right now is that it's very, very abnormal when stocks are down and bonds are down. Usually you've got one saving on the other day. If stocks are going down, people flee to safety and they're going to buy those bonds. And if they're wanting more risk, they might lighten up with their bonds and they're going to own stocks. And so quite often they're on opposite sides of the teeter-totter. But what we're all feeling right now is the teeter-totter feels like it broke at the middle. And it's definitely something that's abnormal. What you're looking at right now, if you can see it, is a chart showing back annual returns. Now, we're only about a halfway into the year, but the only year on record, and our numbers are going back in some cases 50 years. 2008 is really the only thing that's rivaling what we've got going on right now. And so really what we're trying to analyze right now is how much of the fear that all of us fear, given an Eastern European war, you've got fears of inflation, fears of rising interest rates, and then the fear of recession. How much of that is already baked into the cake?
Mm-hmm.
And my guess, and I think most of you would agree, that a lot of it is priced in, because usually once the fears start to subside, the market has already gone up considerably. And so what we're trying to analyze now is really how much of that fear is baked in. And history would tell us that by the time we are the most scared and we think things are only going to get darker or get worse, majority of the time the fear has been priced in.
So
Go ahead.
I was just going to say, explain the recession. What exactly? I mean, the recession, you hear that on the news every day. Recession, and fear sells. We know that. We hear it all the time.
I mean, by definition, it's 2 consecutive quarters in a row with negative GDP growth, essentially the economy contracting versus growing. So you did hear, and that was a lot of the talk of the news lately with the last quarter was our first negative quarter of GDP in a while. And so the economy is shrinking. And a lot of that has to do with inflation, too few goods and available. And, one of the things that we talked about before was, the Fed put a bunch of money in the system. The government put a bunch of money in the system. And so consumer spending went up almost 14% for the first 4 months of this year. Whereas the supply side of it, the products was only up about 4%. And so when you have that sort of spread, that causes the inflation and the shrinking of the economy, I think. And so that would be the definition of a recession. But highlighting too, kind of what Jason was talking about, I have a slide right here that talks about that fear and that panic. And usually when we're kind of at the bottom of a market, this is going back, and those of you that can see the slide, going back to 1942, bull market versus bear market. In our world, think of the bull as, everything's good. Green market up 20%, bear market's negative. But in the middle there, you do have some recessions. And, things that I've shown clients and talked with and highlighted and all of you are aware of is that, recessions do happen over time, but they're usually not long lived. And a lot of times, as you can see by some of the gray areas here, when they have actually hit, the bottom of the market is already hit by the time we're in a recession, usually, or near the bottom. And that's because the markets have always been kind of leading indicators. And so, and I know that we'll talk about a little bit more on our thoughts of where things are headed in other areas. But, just because we've had, 1 quarter of negative GDP growth and, fear of a recession the markets are usually telling us that when the pain threshold gets to the point where it's at, it's usually a pretty good sign that we're getting near a bottom. And you can see that the good times are usually a lot longer in duration than the bad times by the slide that's up with roughly, the average positive markets that go up over 4 years, and the downside there with the bear markets are under 1 year, and there really isn't one in history that was 2 full years. And so obviously it's favorable for the long-term investors.
Kyle, I think what you can also notice there on your chart is that as we learn about recessions, we're told after the fact. There's no economic indicator that's ever going to tell you, our clients, that a recession is going to be here next month, a recession is going to be here next quarter. We find out the data about the GDP after it's already occurred. And
Correct.
as many of these cases that you've seen, I like to tell clients many times that the recessions are far more common than you might be aware. Over the last 140 years, I think we've had 20. So the average is every 7. And the duration of these recessions, I think, isn't more than 2 years on average, or even less than that. By the time where the market is bottom, we're out of it and beyond. And by the time that we often figure out that we had a recession, the market bottom is already behind us. And so trying to be preemptive or market time and get around it and get ahead of it, by the time you actually find out that we had a recession, the market's usually bottomed behind you.
Well, there's a economist named Samuelson that I think he said something like the stock market is, predicted 9 out of the last 5 recessions. It's something like that. I mean, that's to your point, Kyle, about the leading indicator. It is a leading indicator. I mean, the market, is a lot smarter than we sometimes give it credit for, whatever it is. And but sometimes it's a head fake. I mean, we've had these type of drops many times over the last, let's say, 20, 25 years, and not to be followed by a recession. Because even the term recession is so technical. If you have negative economic growth for 4 months, that's not technically a recession. So you can't count that. I mean, it still feels like it. And when folks open up their statements, it really feels like it. And that's that wealth effect, you might even argue led to a lot of the big spending numbers that have been coming in over the last few quarters. You feel like, hey, value of my house is up. Maybe the total amount of debt or money that I owe people is down, and people are willing to spend, and you compound that with the fact that people have been, for the most part, locked up for going on a couple of years now, or at least have felt like it. We have clients that want to travel and do things and go see family, and they have not been able to do it for whatever reason. Maybe the country that they want to go to is locked down, or the state that they go to, or even the family. You have somebody that's really sensitive to COVID in this case, or whatever the case may be. And people, there's still a lot of pent up demand for getting out and doing things. So I saw some statistic the other day about concert ticket sales, like hit record, not total concerts held or anything like that, but total concerts tickets have been sold is off the charts in terms of the fourth quarter. So I think we're going to get into doing a lot of that other stuff, and whether or not earnings are up or down for some of these big companies is in some cases not going to affect very much in terms of our client behavior. They're still going to go. So
for sure, yeah. I think a lot of the things we're saying are you got to be careful. Fear sells. You got to be careful of the permabears, we call them, the permanent bears, and they're out there. People make predictions all the time, just like Chris was saying about, this is going to be bad, this is going down. I mean, even when COVID started, all the predictions were outlandish compared to what it really turned into. So the data, the historical data just doesn't bear out that, the predictions that get made, that it's always going down and it's always going to be negative. So the permabears, like I said, they get on TV a lot, but don't reflect what's actually happened in history. So
we all know too, Adam, how many times we've heard the client say, well, I saw someone on TV and they said the market's going to go down another 20%. Yeah. I kind of take these guys.
That person never comes back on when it doesn't go down 20%. They
also don't have any money.
Go down. Yeah, and what do we always say, right? If you keep predicting that the market's going to go down, eventually you're going to be right. It's the old broken clock. Right. Like it's right twice a day. Eventually you're going to be right, but it doesn't mean that over time that's going to be the way to make money.